What's up, everybody? It's Stephen A. Williams, president and founder of the creditrepairshop.com. And in today's video, we're going to talk about the importance of understanding how your credit scores are figured. There's a lot of misconceptions that are going around. There are people that are doing things to hurt their credit, even when they have so-so credit or good credit or even excellent credit. They're making mistakes that can hurt them down the line that they don't even know about. There's an old saying that, you can have a frog in their inside of a pot of boiling water, and they don't know that they're inside of that pot of boiling water until it's too late. And so I want to make you aware of some of the mistakes that I see a lot of people continuing to make, and these mistakes end up catching up with them in the future. That's the thing, is that you'll think that you're doing things the right way, and then all of a sudden something will happen when you either go to try to get a mortgage, trying to move to get a house, or you're trying to get a car, or you're trying to do something that you're going to need to utilize your credit, and you've been looking at your credit and it's like, my credit is good. Why did this happen to me? I was on in a email back and forth. Can you argue by email? I think you can. I was in an email back and forth, and it wasn't really an argument. It was just a gentleman that was expressing his frustration with his credit. And I said, just let me look at your reports. Rather than going back and forth, let me look at your reports and I can tell you what you might need to do. And when I looked at the reports, basically had been paying all of the stuff as much as he could, except for he had the late payments on there. But the conversation was like this. It was going back and forth. He was like, I think that you should be able to raise my credit scores, and because I just have some late payments. It's not just have some late payments. I'm going to show you why late payments could be like one of the worst things that you could do to yourself regarding your credit if you have nothing else wrong with your credit. It's like this. Remember when we were kids and our brother or sister did something that was real bad, and they got in trouble, and they got in bad trouble. And then we did something that was like not as bad, but we got in trouble. But we suffered the same consequences that our brothers and sisters had suffered. This is what's happening with people that have even late payments, and they've paid everything else, and they just had some late payments. You are being punished the same as an individual who has collections on their accounts. The way the algorithm is written is not just written to say, do you have a collection? Do you have a charge off? Do you have a late payment? No, this is the way that I believe is truly written. And I know some people might try to argue, but how can you really argue with someone who has literally seen, I would say, over the years, upwards of over 100,000 credit reports? And there's some stuff that I've seen that is suspect for certain areas, suspect for certain states, and also suspect for income. But one of the things that I do that is across the board in common, if your credit is clean and you make one tiny mistake, it could lower your scores drastically. Like, you're like, what did I do wrong? Was that late payment that bad? Yes, it is. And I'm going to go over a refresher on how scores are figured, because you need to get this inside of you so you don't make these mistakes. And then I'm going to demonstrate to you later why this is so important. Like, I'm going to show you visually so you can get this in your mind so you can understand how this whole thing works. Okay, so this is how credit works. And credit is the foundation. Credit is the foundation of your wealth. We live in a credit society, and you can actually utilize credit to allow you to be able to invest in things, but also be able to get things, and as long as you don't go overboard, pay less for them and utilize the cash that you would have put to pay that off in cash into something that can generate a return of investment for you. See, that's some of the things that people don't look at it that way. Is if you were, let's just say you had bad credit and you had $20,000, you need to go buy a car, and you're like, okay, I don't want to have any monthly payments. I could just pay $20,000 for the car. Yeah, that could be good. But what if you were able to put $5,000 down, have a low down payment, and you could put $15,000 into an investment, and you're able to make, $20,000 a year on that investment, or even like $5,000 a year on that investment. See, that's why it's very important. Get the credit side taken care of. Stop chasing all of that other stuff. Get the credit stuff taken care of first, because that's the foundation of you being able to get all of the other stuff that people show on these videos and the stuff that you want, that you have in your mind as your dreams. None of it is going to work unless you just get outright lucky, which can happen, but most people don't. It's going to come through hard work, and it's going to come from having a foundation of having good credit. So now, 10% of your credit, of the algorithm, the way the algorithm is written is that it's going to base 10% on the credit that is used, on what types of credit that you're using. And it's a very important number. It doesn't figure, as big in the whole scheme of things. You may not think that it is as huge. What is 10% compared to 35%? But it is huge because it's like a piece of the puzzle. So you got to pay attention to it. The types of credit that you have. You could have, credit card type loans. You can have automobile loans. You can have a payday loan, personal loan. So you got to pay attention to the types of credit. And certain types of credit will actually make your scores go up. So if you have an open line of credit, like a regular line of credit or a revolving line of credit will actually help your scores go up. Most of you know that because that's, one of the things that people always talk about. So now the other part is 10% of your score is also figured on the new credit that is placed on your credit report. So you can see how these two kind of interact with each other, because it's going to say, okay, what type of credit did you have? And then what type of new credit have you placed on your report that is different from the month previous? So this stuff is always being figured. So you can see the different types of credit that you can place on there. Now, you got length of credit history, 15%. So now you can see how all of this side right here can work with each other. The type of credit that you had, and then that's going to also coincide with the length of the history, and then the new credit. So if you have new credit that's placed on there, your length of history is going to go down. So even if you had a long credit history with, let's just say, one account, for example, to make this simple, you got one account, you've been paying on that for 24 months, and then you add a new account on there, and depending on what type of account it is, the algorithm is going to read it one way or another way. But it's going to, when you do the averages of the amount of history, the length of history, your overall history is going to shorten. Now, I'm asking you, do you know why it would shorten? If you've been paying a couple of years on one account, and then you open up a new account, why does your history shorten? Because the algorithm is going to read an overall. The algorithm is reading an overall on this whole side right here. So now the next one here is your total debt. A lot of people don't even know that this is something that is figured with the algorithm. Have you ever filled in an application, and on that application it asks you, how much money do you make? Like, okay, I make $100,000 a year, or $50,000 a year, whatever that amount. That is actually put into the system. And based on your debt to income ratio, right here, this is going to be figured 30%. Because a lot of people are wondering, like, okay, I got my total debt is, 200 and some $1,000, including your house. But how is the credit algorithm reading how much my income is? Like this, I didn't tell them that. Yes, you did tell them that. When you filled out that application was inputted into a system and the algorithm is reading it. So it's looking at, okay, this is how much debt this individual has, and this is how much reported income this individual is stating. So it is going to figure a debt to income ratio. And that's 30%. And the reason why that's going to rate very high is because they want to be able to tell their customers, which are lenders and finance companies and whoever, what is the risk ratio of this individual being able to pay us back. So it's going to really, really feed into or calculate all of this side here and this here, but it's going to calculate and it's going to say, well, based off of the information that we have been able to gather, based off of the type of accounts, how many new accounts this individual has placed on their credit reports, and the history of them being able to pay, and the total debt that they're already carrying, and then the debt that you would be adding on to there, the risk factor is this number. And based off of that lender, they're going to say, well, if individuals have this risk factor, decline them. If individuals have this risk factor, approve them. If individuals have this risk factor at this number, approve them with this high interest rate. If they have it at this factor, that's a certain number. I don't know that number, but if they have it at this number, then give them a medium interest rate. If they have it at this number, give them an excellent interest rate. That's how it's figured. That's the inside of what all of these numbers mean and why it's so important for you to pay close attention to them. The next one is your payment history. If you were loaning some money to somebody and they had a poor payment history, how many times would you continue loaning them money? You probably would just do like I end up doing, just be like, here, I'm either going to give it to you or it's not going to be given to you. I'm not going to loan anyone any money because you don't even, number one, you don't even want to get into that situation with people. But and number two, if the person has a bad payment history, it's going to figure into these factors here on, even if you get approved and you have those late payments, well, we're going to just rate you with a higher risk. We'll make that loan to you, but we're going to put you into a bad situation where you're going to end up paying a higher interest rate. So now they're taking away your wealth that you could have put aside to an investment or just savings, just saving money. Like you don't even need to invest it. Just put $1,000 a month away. Like you can't even do that because that money is going to them so they can put that away for their family, their friends, for whoever they want to give money to. So it's very important. You got to make your payments. You can't have late payments because that payment history is going to count huge when it comes down to it. So now, let's go into here. I talk about how little things can end up being a big thing. Like, if you let little things like stew, remember I said about that frog being in that pot, and then all of a sudden it was like when it was so hot, it was too late to get out of that pot. These are the types of things that people do that I see a lot on people's credit reports. It's like it was a little mistake and another little mistake and another little mistake. That's what people do. They just look at it as, I made a little mistake. And then they end up making another little mistake. And then they end up making another little mistake, little mistake, little mistake. A lot of little mistakes can make a big mistake. And what is that big mistake going to end up costing you? A lot of little mistakes, late payments, too many inquiries, debt to income ratio, lack of history because you have too many new accounts. You thought you were doing a good thing putting these accounts on there, getting these little cards, all these different cards that all of these people are telling you to do, and you're making these tiny little bitty mistakes. And then even if you utilize those cards because they said, hey, use that card so you're able to, show some history to boost your scores, but now your debt to income ratio is too much. And then while you were doing that, even if you did get approved, now you got too many inquiries. And then if you got into too much, you had too many payments going out because, you wasn't handling your money. Now you got some late payments. So you had this little mistake, this little mistake, this little. Then you go to try to buy a house and you get denied. And then you're like, I didn't make big mistakes. I just made a few little mistakes. Well, those little mistakes ended up becoming a big mistake. Or you get approved and your house is at 8%, 9%, 10%. I'm seeing this. I'm seeing this with people. They're going out and getting cars, 22%. I'm seeing this with people. This is, let me make this clear to you. And I get excited because number one, this is the lesson I had to learn. And when you learn this lesson, you start to find out that you don't have to go out and chase money. Some of the time solution is right there in your home, right there in your mind, is to get a hold of all of this stuff that you might be doing so you can end up getting your credit in the right position, getting your debt in the right position, not making the little mistakes. And then what if 22% on a car ended up being 2.9%? When I went in there and I got my car years ago at 2.9%, and I was looking at the interest rate that they were offering people that didn't have good credit and the vehicle amount, there was people buying Range Rovers and they were coming out of that dealership with 7, 8, 9% interest on a car. They won't let you come out. If you come out of there with 22%, you might as well say that you changing your Range Rover into a house payment. I'm coming out of there, car that's a $150,000 car with a payment barely over $1,000. And people coming out of there with payments close to $2,500, $2,600, $3,000. And I'm like, people are doing that? And then they wanted to get my business so much that they said, we're going to throw in these things for you. If you watch my videos from before, people with good credit and excellent credit, they even get treated different. People with excellent credit, people with excellent credit get treated way different. So this is wealth. Do you think I didn't just go and blow the money that I wasn't spending on the car payments? I went in and I invested that money. But that's money that I was already going to have. Going to get a house and you're paying 8, 9, 10%. Now, to remain consistent, even if you had, you made the mistakes and you were able to get approved and you went and got the house, you go and get the house because you're paying 100% interest without, if you're renting, you're paying 100% interest and you're under somebody else's, you don't want to be under the landlord's, whatever. So get your house, but then get everything else in order so you can get to where you can refinance that house. That's me remaining consistent with that because you will be paying 100%. But If you didn't have these mistakes, and even though the interest rates are high right now, you're going to be in the 5s or 6%, depending on what type of loan you're trying to get, you would still be better off, and you would be able to put that money into investment or just saving money. Like, this is a huge deal. That's why I want to go over this. So please pay close attention to your reports. Look at what's on there and just buckle down and say what needs to be done here so I can move forward, move forward now and in the future. If you need help with your credit, please visit us at thecreditrepairshop.com. Watch the video of what makes us different so you can see my 8-point validation process, my 2-phase settlement process. If you need your credit reports and scores, go to the website your3scores.com. Grab your TransUnion, Equifax, Experian credit reports and all 3 scores. If you have debt collectors coming after you, I want to give you my 3-pack of letters: statute of limitations, debt validation, cease and desist collection activities letter to stop debt collectors from coming after you. Thank you for your time. Post your questions and comments. Subscribe to the channel if you haven't done that. This is Stephen A.